S corporations. You know, just as an aside, I think for the, it's hard for me to say, but 25 plus years that I've been practicing, I think there's probably been more misunderstandings around S corporations than just about any other entity that I've regularly worked with people on. The limited liability question comes up even today, where people say that that they have you know, that they don't want to be an S corp because they don't want to lose liability protection. There's also people who think that they have an S corporation even though they haven't made the appropriate filing with the IRS. They think that by simply declaring themselves to be an S corporation, they've effectively created an S corporation. There are people who think they have S corporations with ineligible shareholders, not realizing that what they've done is effectively eliminated the availability of S treatment for their company. So it's one of those things that really requires just a little bit of basic knowledge, but a lot of, you have to check no pun intended, you have to check the right boxes in order to form an S corporation. When it's properly formed, it does give you limited liability, no different than a C corporation. All of the same rules apply in terms of limited liability, in terms of respecting the corporate form, all of those things. But you will have limited liability with an S corporation. You will get pass-through tax treatment, as Robert said, and what passes through are the items of income or loss that the corporation generates, and it's passed through to the individual's return, the owners, to address on their returns. It's not the actual cash distributions themselves, but the allocations of the income and loss that they get the benefit of. And again, that's a little bit of a difference with the C corporation. Because the C corporation, a C corp could be tremendously profitable, but not distribute any money out, and the shareholders of the C corporation have no additional tax liability. An S corporation could be very profitable on paper and not have enough cash to distribute out, but the S corp shareholders are still going to be hit with tax obligations because it's that profit that passes through. You do have to make a filing to have a valid and effective S corporation. You form your C corporation, you get a tax ID number from the IRS, and then you file what's called an election to be treated as a subchapter S corporation. I believe it's 2553.
2553.
So you have to file your form 2553 with the IRS, and that provides some basic information about the shareholders of the corporation, and I believe the IRS has to approve the election. They used to. I don't know if they...
It's perfunctory, but you do want to have some proof that you filed, that you would like to keep the acknowledgement and letter from the IRS in your corporate record book, because at some point the question will be asked, are you sure you're an S corp?
Yeah.
And you'd like to be able to prove that.
Robert and I worked on a transaction about a year ago, very significant transaction, public company buyer, multinational, and it was for a significant amount of money. And I think we had, two different in the file, we had two different notices from the IRS approving the S election, two different dates, which were, 10, 15 years apart. And it's those sorts of things that in the middle of a deal can really cause problems. So if you're working with a client on an S corp, and the intention is to file the election to be treated as an S corporation, make sure it's clear between you and the accountant and everyone else. Make sure it's clear who is going to be filing the S election, and make sure that when you do file the S election and you get your acknowledgement back from the IRS, that you know where it is and that it's in the file with the corporate records and everything else. Now, we will talk a little bit later about the S election. Generally, it has to be made within 75 days. there are some remedies available now that weren't even a few years ago, but there are some remedies available now if you miss the S election. It's one of the many of the other tax requirements that we deal with frequently, like 83B elections and filing dates and things like that. There is no there's no corrective remedy that you can take. That's not true with S elections, and we'll talk a little bit about that in the tax piece. But generally, you do need to file within 75 days of your formation as a corporation in order to get S status. Here's where the S Corp can really fall down a little bit. You cannot have more than 100 shareholders. Your shareholders generally have to be natural persons. There are some trusts and some other corporations that can hold shares of an S corporation, qualified subchapter S trusts and the like, but it's fairly complex. So generally you're looking at a situation where your shareholders all have to be natural persons. They can only be resident aliens or U.S. citizens. Anyone else, the cousin over in Germany that's been working on the project with you and you want to give them a piece of the business, you cannot do that. You will blow your S election.
Yeah, in fact, if you have an owner that is a resident alien, you typically want to deal with what would happen if the alien loses his resident status. Mm-hmm. And one of the approaches to dealing with that is to have a shareholders agreement which provides that the shares owned by the resident alien owner will be deemed to have been offered offered for sale to the company. Right. In that event, so that we can eliminate the shares being held by a non-resident alien.
Right. Yeah, because if they're allowed to retain the shares, you will blow your S election, and basically you have to then file. The corporation becomes a C corporation. You have to file taxes on behalf of the corporation, and it may change your whole the operating model that you've laid out may not work anymore. So, right. The biggest drawback for S corporations that are looking for outside investment is this last one. There's only one class of stock in an S corporation. You cannot have preferred stock. So any type of investment where the investor is looking for some sort of a return before the other investors get their money back, or some sort of dividend that accrues annually and gets paid when the business gets sold, very common attributes in a venture capital financing or growth equity financing, those are not available to an S Corp. Creating that second class of stock will blow your S election. You can have the same class of stock, but have some be voting and some non-voting. That's okay, but that's it as far as the second class of stock goes. Anything beyond that, any class of stock that has rights or preferences beyond what the rest of the common holders get will blow your S election.
So suppose you have a client that is an S corporation, and there's a potential investor who wants to have a preferred equity and might not even be an eligible shareholder, may not be a natural person, sure. Maybe some kind of fund, maybe a corporation, something that doesn't work. So the question is, what do you do? Well, one thing you could do is you could simply terminate your S status. You could form the new class of equity and take in an owner which doesn't qualify, if somebody's not eligible, and go forward as a C corporation.
Mm-hmm. And let me just interrupt for 1 second. That doesn't require any corporate filings. It doesn't. I don't even know that it requires it. Well, it may require a termination of S status filing.
No, it happens automatically.
It happens automatically. Mm-hmm. So it really doesn't require any filing. So again, another misconception about S corporations, it's not like you have to let the world know that you've now gone from an S corp to a C corp. It's just a tax provision.
And this may be the way that you go. The investor may have enough muscle to force this. The investor may be indifferent as to the tax status of the entities, doesn't care about flow-through treatment. Its investment objective is different, and may push for that result. Now, there is a potential workaround, and that would be to use an entity that we learned about 15 minutes ago to hold the operating assets of our S corporation and to facilitate that investment. So how does it work? Our S corporation takes all of its assets, all of everything that it uses to operate its business, and drops them into a newly formed single-member LLC subsidiary. Now, the formation of that entity is not a taxable event. In fact, that entity that we just formed, that new single-member LLC, is a disregarded entity.
Right, 'cause you can have disregarded entities if the single owner is either a natural person or a corporate entity.
Could be anything. Now, our investor, instead of investing in our LLC, invests in our LLC subsidiary. The money goes in down there.
You mean instead of the S corp?
Instead of the S corp, invests
in the LLC.
So what have we done? Well, with respect to the existing S corporation shareholders, nothing. They continue to own an interest in the S corporation, which owns an interest in the LLC. And our ineligible shareholder now owns an interest directly in our LLC down below. Instead of one entity, we have two, but we've been able to do it without upsetting our existing S corporation owners. That drop down into a newly formed LLC subsidiary.
And again, you know, with an S corp, it's the same formation requirements as a C corporation. When you file, for example, with the Commonwealth of Massachusetts or the state of Delaware, you don't have to do anything different if you're going to elect S status eventually. You simply make your corporate filing, wait for them to approve it, and you're done. I think we have another question coming in.
Yeah, let's see if I can follow it. If an entity elects to be an S corporation from an LLC, can you then return to an LLC?
Well, that's a little bit different. What you're talking about there is actually changing the form, the entity form. The state statutes, Delaware provides for a conversion, and it's the conversion statute. Delaware provides for a conversion from just about any form into another form. So LLC to corporation, corporation to LLC, limited partnership to LLC. Some of the other states aren't quite as flexible yet, but I think they'll get there eventually because Delaware usually takes the lead on these things. That's actually a conversion, and what you have to do is you have to look to state law. So depending on what state you're in, you have to look to state law and say, does it allow me to convert from I think from an S corporation or an LLC to an S corp, and then subsequently from an S corp back to an LLC. But the state statutes, aren't going to say S corporation or C corporation. They're simply going to say corporation, and you have to deal with the tax aspects at the IRS level in terms of whether or not you can qualify for subchapter S status.
Yeah, I think that the corporate statutes are pretty flexible. Mm-hmm. I mean, you can almost do a Bruce Jenner in most states under the corporate statutes. I think what's real interesting is the tax aspect. Mm-hmm. An LLC, we're going to learn later, can make an election to be taxed as a corporation. And if the LLC makes an election to be taxed as a corporation, that corporation can make an S election. Mm-hmm. So An LLC can go from an LLC taxed as a partnership to a corporation with an S election by checking boxes, and we're going to talk about that later. There are some tax issues you need to think about, particularly when the LLC has a significant debt. The conversion from an LLC to a corporation, when the corporation has significant debt, can trigger phantom gain for reasons we'll talk about later. Now, the follow-up question was, can we go in the other direction? And the answer is yes, you can check the box. I don't know whether Bruce Jenner is going to be able to go the other direction quite as easily, but you can with a corporation under the statute, but for tax purposes, a corporation which becomes an LLC has a taxable event, has a taxable liquidation. And so we'll have a tax in that direction.
Right.
So going from an LLC to a corporation is generally possible, though you have to watch for debt. Going from a corporate entity, either a C Corp or an S Corp, to an LLC will invariably be a taxable event. And so for that reason, an LLC is more flexible and is generally the place to start.
Yep, I would agree with that. And again, from putting aside the tax consequences for a moment, you can go from an LLC to a corporation and then back again. Even if the state statute doesn't permit it, we can do what we call conversion by merger, or some people call them migratory mergers. You could create, if you're an LLC, you could create a corporation, merge the LLC into a corporation with the corporation surviving. Now you're a corporation. Then you decide later on you want to be an LLC again. You know, if the state statute doesn't provide for it, you can set up an LLC, merge the corporation into that, and now you're an LLC again. As Robert points out, though, and very appropriately, there are going to be tax consequences that are likely to be applicable to some of these because of the underlying tax rules and the way that when you merge an LLC out of existence, it's considered a liquidation. So there are going to be some tax consequences that you have to be very aware of before you advise your client on how to do this, or if they can do this. From a corporate perspective, it's not hard to do. You can either look to the state statutes for conversions, or you can do the mergers. So I want to just touch on one what I think is a significant ethical issue here, and it's it's something that has come up from time to time, and it touches on a number of the things that we've been talking about today. When you form your corporation, so you form your corporation on July 1, and you file your subchapter S election on July 15th. Everything is done timely. Everything is done correctly. You identify at that point the two shareholders that or three shareholders in the S corporation, and everything is great. And your client comes to you, and they want to give some equity to, again, the cousin who's overseas, or the person who's more likely the person who's been doing some coding for them or some development work for them, but isn't a resident alien or isn't a U.S. citizen. And what do you do here? How can you get around this? You know, we've been asked from time to time, well, how does the IRS know? You know, we don't have to update the 2553 once it's been filed. We don't have to amend it. Every time we issue stock, we don't have to further report to the IRS that that we're doing this. And that's right, you don't. But you have made representations that the people that you've issued stock to are eligible shareholders, and that you will make the appropriate notifications to them if you terminate the S election, whether voluntarily or involuntarily, because you take on a non-eligible shareholder. So we get asked this all the time. Can't I just put some stock in their name? Can't I just issue them some equity? And the answer is no, you really can't. Doing that, in my view, puts both the lawyer and the client at risk, because frankly, the lawyer should know better. And it puts you at risk, in my opinion, with the agency you least want to be at risk with being the IRS. And as a former employee of the IRS before he joined us, Robert can tell you, you don't want to be at odds with them. And it also puts the client at risk as well. There are some things that you just can't get around. And there are some things that, even though the rules seem somewhat foolish or arbitrary, you just can't finesse them. You may be able to give them some form of an option or a warrant that they can't exercise either until the S-election is terminated, like the business is being sold, for example. You may be able to give them some sort of a bonus agreement that says that this is what you'll do for them at the point that the company ever hits it big, but only then, and not something squishy like, well, maybe we'll do that, or maybe we'll issue some to you at the end of the year. It's a very, it's fraught with peril, and the best advice is simply to be very familiar with the rules involving eligible shareholders, and be very firm and very clear in your advice with your clients. If they can't do it, if it's something that's going to put the S-election at risk, you have to let them know that, and let them know that they can't do it. Because we have, we work with a lot of technology companies. It's very common that that the people are, I say overseas, and that's really oversimplifying it. It's U.S. citizens and resident aliens. That means people from Canada are excluded. People will say, well, it's, they're not on the restricted list. It's not someone in North Korea. It's not, it's my cousin in Canada. It doesn't matter. It's a U.S. tax law that you have to comply with, and it's not something that can be finessed.
Yeah, and one of the troubles is that these issues sometimes don't arise until the due diligence process is well underway. Mm-hmm. So you've put together a deal, you've got an exit, you've negotiated a price, and the buyer is now looking at these things, and these footfalls can become big purchase price issues. Mm-hmm. And that isn't the time you want to deal with it.
Right.
You really need to stay ahead of these issues so that you can deal with them before they become economic issues for your client.
That's exactly right.